We're here today with Scott Peters. Scott, good to see you today.
Nice to see you. Thank you for having me.
Thank you very much. Boy, 2012 was a great year for REITs. We're seeing a full recovery in most sectors. Tell us a little bit about Healthcare Trust of America and the value proposition that you see for your company today.
Well, thank you. I think 2012 for us was a very good year. We were fortunate. In June of this year, we went public, and it was a big thing for us. We were able to get public and without doing any IPO or raising any equity. And we're a company that is focused on medical office buildings. We're about $2.5 billion of invested dollars, 91% occupied, investment grade company, and we have a 5.75 dividend on a $10 value. So we think we're very well positioned in today's current environment, moving into 2013, coming out of 2012.
Sure. You mentioned focus. I mean, there's a lot of larger diversified REITs that aren't focused on pure sectors. Tell us a little bit about your specific sector, Scott, and the medical office space that you occupy.
Well, we decided 3-4 years ago to dedicate ourselves to being what we call a pure play, and dedicated on medical office buildings. We think that with the recent Affordable Care Act, that medical office buildings on campus will become core critical real estate for healthcare systems over the next 5, 10, 15 years. We're fortunate. We're 76% on campus. We're 96% on campus or affiliated, which means that we have assets. If they're not on campus, then the healthcare system occupies greater than 50%. As I mentioned, we're 91% occupied. We've got 57% of our 12.5 million square feet with credit-rated tenants and 40% with investment-grade rated tenants. So doctors don't move. You know, I'm sure all your readers have been to a hospital or been to a medical office building, been to a campus that a healthcare system has invested a lot of dollars in. Those are what we like to own. We like to own what we consider to be traditional real estate. Great locations, leases to healthcare systems, leases to physicians, leasing to physician groups, typically 3, 5, 7-year lease terms.
Sure. That's an incredible margin of safety in your portfolio in terms of diversification. I think you closed on a property this week in Texas, I believe? We
did, and it's what we think is our core acquisition. In 2012, we acquired $295 million worth of acquisitions, about 99% occupied on campus, which is very important to us. This one that we recently closed in Dallas was an off-market transaction. It's with a healthcare system that's getting off the ground in Dallas. It's on campus. It's 100% occupied. It was $27 million. We like $25 to $75 million acquisitions. Being a $3 billion company, we can grow our acquisitions. We can grow our company with 3, 4, 5, 6, $25 million acquisitions. We're focused on MOBs. We don't want to be diversified, and we certainly don't need to do $2, $3 billion of acquisitions on an annual basis to grow our company.
Sure. You mentioned growing acquisitions. What about your balance sheet? I understand you've got a pretty conservative capitalization. How are you growing the business?
Well, we've been very conservative. We continue to be conservative. I think that when an investor looks at a real estate investment trust, they're looking for dividend. We think we've got a good yield. They're looking for safety, which means that you need a strong balance sheet. We're investment grade. We acquired that rating in 2011. Our debt right now is 32% to enterprise value. We're going to continue to be cautious. We're going to continue to buy great assets on campus or across the street from a healthcare campus, focus on credit, focus on occupancy, and grow our dividend, because we're focused on two things: continuing to grow our dividend at a reasonable pace, and also increasing our net asset value. That will generate two things for our shareholders. One, a steady yield on an annual basis, and two, hopefully an increase in share value so that they'll be able to recognize both the dividend and appreciation from a shareholder perspective.
Sure, and you've got quite a few retail shareholders in that you came from the non-listed REIT into the public space. How has that helped you today in terms of being a public REIT versus when you were a non-listed REIT 2 years ago?
Well, I started the company in 2006 and always wanted to be a public REIT, so we've structured ourselves and modeled ourselves to look like a public REIT. Came public in June of 2012. We were very fortunate when we were raising equity during the 6 years through February of 2011. In 2008, 2009, 2010, we bought over $1.8 billion of our $2.5 billion of assets. Tremendous opportunity. There wasn't a lot of buyers. There was a debt crisis going on. Cap rates, which were the value you pay for acquisitions, were much higher than they were today, so obviously we got a great opportunity to buy. We were able to buy with cash, which also increased our ability to maximize our investment. So we were fortunate. During that time period, we weren't subject to the vagaries of the public markets. We didn't go through the debt crisis. We had cash. We were able to utilize it. And today it's going to pay off as we think we've got a great portfolio that's located in 27 states and has 12.5 million square feet.
Seems like a lot of runway for that space in the medical office sector. Your dividend today is what?
It's 5.75 or 57.5 cents.
Okay.
And we look to continue to grow that very prudently and patiently. You mentioned how big the MOB space is. It's $250 billion. Right now, public REITs own roughly 10% of that, or $25 billion. So there's a tremendous opportunity for us as a company to focus on medical office buildings, to continue to, we manage our own real estate. So we have almost 80% of our properties, what we call in-house asset management. So we're reaching out to healthcare systems, we're reaching out to the physicians. We actually are in the markets that we own assets. So with the opportunity that are there, with the $250 billion of opportunities, the Affordable Care Act that is moving healthcare systems to monetize their assets because they see 30 to 40 million additional insured coming into their systems. They need to utilize their funds to maximize their ability to deliver medicine. We think we've got a great set of opportunities in front of us, from acquisitions, from asset management, and then relationships with healthcare systems and being able to acquire very good assets.
Your sector is the medical office building sector, so that's what you're focused in. But there are other sectors out there: the assisted living, the pure medical REITs like medical property trust, all the way down to what I consider to be the riskiest, the assisted living, which is obviously under pressure with Medicare and the Affordable Care Tax. Tell us where you fit in terms of your risk profile as it relates to, say, an Omega Healthcare, ticker OHI, or, for example, LCP on that end of the spectrum.
Well, we look at the healthcare sector, and I look at it from two or three different ways. Number one, we're not a diversified company. So as we've talked about, we're a pure play. We're focused on MOBs. We think they're the most defensive. We think they're the most stable asset class within healthcare. We're also not a huge company. We're $3 billion in size. We're not 25 or 20 billion, and those are the more diversified companies that actually have far more operating businesses in their structure. You mentioned a couple that I think are certainly very good companies, but there are issues that are going to be faced as we go through the process of the fiscal cliff getting solved, concession reductions in spending that may or may not take place. So from our perspective, we like being with the MOB, more traditional real estate, with the physicians, with the physician groups, with the healthcare systems. So we're going to stay pure play. We're going to stay where we are, and we really think that one of the reasons to not be diversified is to do what you do very well. And we want to try to do that in each of the markets that we're in. We're spending a lot of time, of effort. We put a lot of investment in our asset management in our different regions, and we want to see that be able to come to fruition over the next 3, 5, 7 years, as we've talked about the many opportunities that we have to grow this portfolio.
Great, Scott. Well, I certainly appreciate you talking to us today, and look forward to seeing more of this sleep well at night value proposition with your company.
Well, thank you very much for having us, and again, thank you.
Thank you.